Stephen Gallo is the head of market analysis at Schneider Foreign Exchange, and according to Bloomberg data, he's #1 when it comes to forecasting and accuracy in the Forex market. Stephen, welcome back to InBusiness. Is the U.S. dollar the best way to gauge panic versus U.S. Treasuries right now?
I think one of the reasons that we haven't seen a larger move in the foreign exchange market so far, Brennan, Margaret, is because of the fact that there's essentially a logjam between the dollar and some of the world's major reserve currencies. So I think this is one of the reasons why you are seeing that buoyancy in the Swiss franc, in the yen. There also is some surprising buoyancy in some of the currencies we normally refer to as pro-cyclical or commodity-linked currencies. In my opinion, there's a lot of protection there on some of those long trades in those currencies because of the risks that are facing the dollar, but also because some of the major reserve currencies are still severely impaired, as you well know.
Still severely impaired. You're talking about the ongoing debt crisis in Europe. You're not necessarily convinced that the market is satisfied with this most recent bailout.
No, in Europe, no, I'm not. I think we've been through multiple acute phases of the European sovereign debt crisis, whereas I think for the United States, we're probably just entering the shadows, as it were, of its first more acute phase of its sovereign debt crisis. But I think, let me just look at the situation on a broader basis, if I can. I think there is a theme here, a broader theme, which is not just limited to the United States or even Europe. It's really related to the entire developed world. And that theme is that the shift away from unsustainably low borrowing costs for net debtor countries or net debtor economies, like, for instance, the United States or Great Britain, that theme is essentially, it's coming to an end. The shift away from unsustainably low borrowing costs is coming to an end. So, essentially what that means for economic agents is we have to get used to higher borrowing costs. The government has to get used to higher borrowing costs. And I think that shift is starting to begin now. And unfortunately, for countries with huge external debts like Great Britain, but more importantly like the United States, I think that shift is going to be rather painful. It's going to take place in both the currency markets and also in the sovereign debt markets as well. So I think be prepared for higher interest rates. I think that's what the takeaway from all this political wrangling in Washington and in Europe really is.
I mean, but fundamentally, I mean, at the very essence, they're two very different crises. I mean, we're questioning the solvency of European nations, whereas in the U.S., we're talking about sort of political gridlock. The money could be there if needed. I mean, do you really think that U.S. borrowing costs are going to have to go up? And why do you think? I mean, the point is made that the Fed's the biggest holder of U.S. debt, but you think that this is going to have to force them to raise interest rates?
I think it's possible that we could get to that kind of a situation. I don't think it's likely in the very near term. Obviously, it depends a lot on how long the sovereign debt crisis in America lasts and how long it takes for politicians to really hammer out something that, injects confidence for the financial markets and investors about the longer-term fiscal outlook in the United States. But I do believe that borrowing costs are going to have to rise, and I do believe that the distortions which the Fed's quantitative easing program has created in the Treasury market is going to create more confusion for investors, not really less. And one of the things that I'm focusing on potentially is because the Fed is still quite heavily involved in the Treasury, in the yield curve, as it were, I think that it's likely that we're going to have to see the effect of a AAA rating downgrade. It's going to have to be split between the yield curve, between government borrowing costs and the dollar. But perhaps even more so in the dollar. We might even see more upward momentum on euro-dollar, underneath euro-dollar, because despite what Europe is going through, because of the fact that additional risk premium cannot be reflected in the U.S. Treasury yield curve.
Very quickly, key data out of the UK tomorrow. I know sterling's down about 8% in the past 12 months. What's going to happen after tomorrow?
Yeah, sterling in the UK is still a very interesting one for me. If I could just say quickly, I actually believe that the UK's AAA rating is somewhat skeptical, even at this stage, despite the fact that the UK has a fairly significant adjustment program in place. What's interesting about the UK and sterling, though, is that because of this back and forth on both sides of the Atlantic between the Eurozone and Washington, the UK has essentially escaped the market scrutiny. I'm not sure that can continue for much longer. And so I'm still fairly much in place on my structural bearish stance on the pound.
All right. Thank you very much, Stephen Gallo. Thanks for making time today.